Hello everyone, this is CMA Swarupa Vishnathan and welcome to my channel. So today we are going to discuss about partnership accounting, which carries a lot of significance in your CMA Inter exam. It is also useful for students who are pursuing their BCom, MCom, CA and CS as well. And we are going to cover partnership accounting in a series of videos. So do subscribe to our channel if you have not subscribed. And if you are a CMA student, we have a specific Telegram group and the link is given in the description where we share MCQs and other updates on CMA exams. So you can have a look at our channel. So coming to the topic today, partnership accounting. So first, let us see what is partnership. Partnership is two or more persons coming together to carry on a business. So they are joining together to carry on a business. They share rights and responsibilities and they share the profits and losses as well. Profits and losses are shared in their profit sharing ratio. They have a particular ratio in which they share the profits, which is called as the profit sharing ratio. And each of the person also brings in some investments, which is called as capital towards the business or towards the partnership. Okay, so the basic crux of partnership is that there has to be minimum of two partners to form a partnership and they have to bring in capital. Capital can be brought in by the form of cash, either direct cash or through bank, or it can also be in the form of certain assets. So coming to partnership accounting. In partnership also, P&L and balance sheet is same as that of a trading organization or a manufacturing organization or any service sector industry. So there is no change in the P&L and balance sheet. Then what is so specific about partnership accounting? The main reason where partnership accounting has so much of significance is because there are two partners or there are two or more partners. Today, a partnership AB and Co is there. Okay, selling electronic goods. Now, the partnership can decide that from tomorrow, they can add one more person. They have a manager who has been with them since the inception of this partnership, and he has contributed so much towards the organization that A and B now want to add C into their partnership. Now, A and B have been continuing the business at a profit sharing ratio of 1:1. They have decided that they will be equal partners. So both of them have invested 10 lakh each into the business and they are sharing profits or losses also in the ratio 1:1. So now from 1st August 2024, they want to introduce C also as a partner of this A, B and Co partnership firm. This is where the importance of partnership accounting arises. That means whenever there is a reconstitution of partnership, okay, partnership accounting comes into play. Reconstitution can be admission of a partner, it can be retirement of a partner, it can be death of a partner, or it can be dissolution as well. Dissolution of the firm or closure of the firm in total. Okay. So today in this video, we will first start with admission of partner. So when a partner is admitted, what all happens? What all changes happen? Okay. So first change is that now, for example, A and B, they were sharing their profits in 1:1 ratio. Now C is a new partner who is getting admitted for equal share. So now they were sharing one half, one half. Now with C coming into the partnership, now what will be the share of profit of A, B and C? It will become 1/3, 1/3, 1/3, assuming they are equal partners. So there is a change in the profit sharing ratio. So the first change is profit sharing ratio. So when we start with the partnership accounting in case of admission, the first step is we need to note down what is the old profit sharing ratio. Second one, we need to note down the new profit sharing ratio. And once you have identified what is the old profit sharing ratio and new profit sharing ratio, the third step is to identify the sacrificing ratio. So when Mr. A and B were only partners, they were sharing profit and loss 1/2. 1/2 was the profit sharing ratio, right? So 50% of the profit A will share, 50% of the profit B will share. But now with C getting admitted, it becomes 33%, 33%, and 33%. Correct? If the profit was 10,000 rupees, in earlier scenario, in the old profit sharing ratio, A will get 5,000 and B will get 5,000. But now with the new profit sharing ratio, from 1st August 24 onwards, A will get only 3,333, B will get only 3,333, and C is going to get 3,333. Okay, so with a new partner getting admitted, the old partners are sacrificing a portion of their profit in the future. The old partners are sacrificing something for the new partner's entry into the partnership. And hence, we have to find out the sacrificing ratio. The sacrificing ratio is old profit sharing ratio minus new profit sharing ratio. So here it is 1/2 minus 1/3. Now how to find out? So it will be how will you solve this equation? 1/2 minus 1/3. It is 3 multiplied by 1, 2 multiplied by 1. So 3 minus 2 by 2 into 3, which is 6. Again, it will be 1/6. Okay, so they are sacrificing in the ratio of 1:1. If they are sacrificing in some other ratios, okay, here in this case, they have sacrificed in the same ratio of 1:1. If they have sacrificed in some other ratio, that you will be able to identify when you solve this equation. So you should know it is old profit sharing minus new profit sharing, and how to solve the equation. It is 1 into 3, this into this, and 2 into 3, and 3 into 3. So 3 minus 2/6, which is 1/6. So their sacrificing ratio is also 1:1 in this case. So we have noted down the old profit sharing ratio, new profit sharing ratio, and sacrificing ratio. Okay, old profit sharing ratio, new profit sharing ratio, and third one is sacrificing ratio. Now, what is the impact of all this? Why we have to find out the sacrificing ratio? Okay, they are sacrificing the future profits. So what? C is bringing capital. Then that is the compensation he's going to give to the partners. Correct? This question can come into your mind. So when we are doing a reconstitution, there is an aspect of goodwill. Okay, what is goodwill now? A and B together have set up this AB and Co partnership firm. Okay, dealing in electronic goods. They have set it up somewhere in 2001. Now it is 2024. Okay, so there is almost 23 years. 23 years of work that is being put in by Mr. A and Mr. B building this brand. Now today AB and Co is one of the most popular brands in electronic goods. That is because of the efforts put in by Mr. A and Mr. B over the last 23 years to build this brand. So C joins today and he starts enjoying the benefits of AB and Co partnership from the day one itself. So in 2001, when they set up AB and Co partnership, they were hardly getting any profit. But AB and Co survived, and Mr. A and Mr. B had put in their effort and their uh, time and effort and energy to bring this business up. Mr. C is enjoying the benefits of the brand value which is created by A and B with their own efforts. So he has to compensate A and B. Today I am going to get the profits which has come because of the efforts done by A and B in the past. So right now when I'm going in, as when C is going into the partnership as a partner, he's joining in 2004 and he is enjoying the benefits that has accrued over the last 23 years, the brand value accrued over the last 23 years. So he has to compensate A and B in their sacrificing ratio a certain value called as goodwill. So that is where we have to compute goodwill. There are different methods to compute goodwill, which we will take up separately in a different class. So we have to calculate the goodwill of the firm. Okay, and that goodwill has to be, and what is the share that he is going to get? C is going to get. So if the goodwill of the firm, for example, we'll keep it to be 1,000 rupees. Okay, C is going to get 1/3. What is the ratio in which he is getting admitted into the partnership? 1/3. So C is going to get 1/3 of this 1,000. And the benefit that he's going to get, which is 1,000 by 3, which is 333, correct? So 333 rupees that he is going to get as a benefit because he is joining from 2024. He has to compensate A and B, and he has to compensate A and B in their sacrificing ratio. Okay, so A and B has to compensate C in their sacrificing ratio because from today they are sacrificing a share of profit in the future, and the share of profit in future comes from the effort that they have put in the past, which we are calculating, which we are terming as goodwill, and we are calculating this is the X 1,000 rupees is the goodwill of the firm, and so whatever is the C's share that he is going to get benefited in future by joining in the partnership, he's going to get it from A and B, and A and B are sacrificing in the sacrificing ratio that we have calculated. So in sacrificing ratio, goodwill has to be adjusted, or it has to be brought in by C and paid to A and B. So the adjusting entry will be C's capital account debit to A capital to B capital in their sacrificing ratio. So when we take up sums, we will understand this concept better, but I hope this is clear for you now as to what is goodwill and why we are adjusting goodwill. What is the logic behind calculating goodwill and adjusting goodwill? So after goodwill has been adjusted, the next point is revaluation of assets. Okay. So all the assets in the partnership, okay, on the date of admission will have to be revalued, because land, I might have brought the land in 2001 at 1 lakh rupees. Now the real worth of the land, it has gone up to 10 lakh. The market value is 10 lakh. So I need to revalue the assets and identify what is the correct position of my assets as on today, and what is the revalued figures of liabilities, and what is the value as on today. So I have to revalue the assets and liabilities, and wherever there is a change in the valuation, that has to be affected through a revaluation account. So revaluation account is just a nominal account. Okay. So in revaluation account, any, so what all things can be there in revaluation? Revaluation, that can be when we value the particular asset or liability, there can be an increase in value of asset, or there can be a decrease in value of asset. Okay. So when there is an increase in the value of asset, what we have to do? Asset is a debit. It is a debit account. So when you are increasing the value of the asset, you have to debit the asset account. So what you will do with the revaluation? You will be crediting the revaluation account. So increase in asset value. If you want to decrease the asset value, you will be crediting the asset account, reducing the value. So contra entry will be to debit the revaluation account to decrease in asset value. So direct opposite, you can take it for liabilities, to increase in liability value, and by decrease in liability. Okay, this you can remember. It will be easy for you to solve sums in the exam. You can remember what has to be debited, what has to be credited in the revaluation account. Okay, and whatever is the net balancing figure of this revaluation account, where will it go? On account of revaluation, like I said, the land value was only 1 lakh, but now the value is 10 lakh. So there is a 9 lakh appreciation in value. Okay, so I have credited the revaluation account, and I have debited my land account. Okay, so the land value has increased and there is a credit in revaluation. Revaluation account cannot be shown in balance sheet. We need to close the revaluation account. So when we close the revaluation account, where will we move this amount? It will go to the partner's capital account. And which partner? Whether it is A, B, C or A and B only. Okay, it will move to A and B's capital account in old profit sharing ratio. Who bought the land? The land was bought in 2001 by A and B. So now when there is an appreciation, who will get the benefit? Only A and B will get the benefit. C is entering into partnership only in 2024. So he cannot ask for a benefit today, correct? So A and B will share in the old profit sharing ratio. So any profit or loss from revaluation account has to move into your partner's capital account in the old profit sharing ratio. Now, reserves. Okay, every business will have reserves. They will not distribute entire profit in the year in which it is received. If the profit is 100 rupees, the partners will take maybe 80 rupees out. And the balance 20 rupees, they will keep it as a reserve for further investment or in case to meet any kind of contingency. So the certain amount will be appropriated as reserve. It will remain in the business. It will not be taken out. Now, a new partner is getting admitted. Whether he can claim a right in this reserve, it is appropriated out of the profit of the past. In the past, he was not there, so he cannot ask for a share in this reserve. So what we will do, any reserves, it has to be written off to old partners in old profit sharing ratio. So we have to close the reserve. Any reserve account any reserve account has to be closed. Reserve is a liability account. It will show a credit balance. Now to close it, what we will do? We will debit the reserve account. Which account we will credit? Capital account we will credit in old profit sharing ratio. So they are just taking out the reserves, which is their money, which was appropriated, kept in the business. They are just taking it out and closing the reserve account. And the last one is your capital account. Capital account, we will have to give effect to whatever we discussed till now. Okay, we have to open a capital account, adjust for reserves, adjust for goodwill, adjust for revaluation. Okay, adjust for any capital that is brought in by the new partner. Okay, then we will get the closing balance. Based on the closing balance, we can draw out a balance sheet of the new partnership, where there are 3 partners involved. It is not a new partnership firm in itself, it's just a new partnership with 3 partners now. Okay, so the steps involved in case of admission is first find out the old profit sharing ratio, new profit sharing ratio, sacrificing ratio, identify what is the goodwill amount, what is the share of the new partner's goodwill, then divide it in the sacrificing ratio to the old partners, then open a revaluation account, find out the revaluation profit or loss, then reserves, distribute the reserves in the old profit sharing ratio, then open the capital account, give effect to all the things that we have discussed till now, point 1 to 6 in the capital account, and then you will get a closing balance. Based on the closing balance and the revalued figures of the assets and liabilities, just prepare a balance sheet and your partnership accounting for admission of a partner is completed. In the next video, we will discuss about goodwill, specifically on how to calculate goodwill in each of there are different methods, like I told you earlier. So we will see what are the different methods to calculate goodwill and how to take out the goodwill separately. Okay, then we will do few sums also in admission. So stay tuned, and I hope the video was very insightful for you, and all the best for your exams. Thank you.